Hello investors and welcome back to the channel. I'm Mitali Thoke here to simplify mutual fund investing and guide you on a smarter wealth creation journey. The year 2025 has been on a roller coaster ride for the world markets. Early optimism faded as slow growth, sticky inflation and volatile commodity prices kept investors nervous. The US and Europe grappled to keep growth and inflation in balance, while China faces a sustained slowdown in property and exports. Geopolitical hotspots have also contributed to the volatility. The Russia-Ukraine war, tensions in the Middle East interrupting oil supplies, US-China trade frictions, and the latest US tariff on Indian goods have all further disrupted supply chains. This means spike in oil prices, currency fluctuations, and inflationary pressure, with export sectors having an additional degree of uncertainty. Domestic measures such as the recent GST rate cut may offer some relief and ease cost pressures for businesses. At the same time, structural changes like the semiconductor race, AI penetration, and the clean energy revolution are producing new global champions and losers. US tech leaders and European green energy companies are outperforming while many emerging markets lag, leaving domestic-only investors at a risk of missing global opportunities. The 2025 lesson is clear. While India continues to grow strongly, overexposure to its markets may leave portfolios vulnerable to local risks such as policy surprises, currency weakness, or sector slowdowns. Given this, international mutual funds may serve as an effective hedge against domestic market volatility while offering exposure to leading global companies. In today's video, we'll explore the international mutual funds selected based on 5-year rolling CAGR, strategic portfolio allocation, sector and geographical diversification, and prudent risk management. Before we move on, please note this video is for information purpose only. It is not a mutual fund recommendation and should not be considered as such. There is no opinion or view on any scheme covered herein. First is the ICICI Prudential MNC Fund. It is oriented towards businesses with solid multinational parentage, sound governance and durable business models, emphasizing on quality businesses with a global reach without moving out of India. The fund focuses on MNCs with robust balance sheets, stable cash flows and better technology or brand leadership that typically enable them to ride economic down cycles. During the last 5 years, the fund has given a rolling CAGR of 23.9%, which proves its sustainability to earn steady returns with relatively less volatility than pure domestic thematic fund. Its holdings are skewed towards large cap and quality mid cap MNCs, which gain from Indian consumption growth as well as from their global connections. As of August 2025, the fund has an asset size of Rs 16.89 billion, with major investments in automobiles 26.5%, FMCG 22.3% and healthcare 16.9%. These industries where MNCs have typically been strong in the market. Key holdings are names like Hindustan Unilever 8.8%, Maruti Suzuki India 8.4% and Sun Pharmaceutical Industries 4.8%. Defensive bets with support from global parentage and India's growth potential. In a world where trade tensions, tariff changes and currency fluctuations affect markets, MNC-backed firms tend to offer relative stability on account of their international size and risk management strategies. Second is the Motilal Oswal Nasdaq 100 Fund of Fund. It provides direct exposure to the Nasdaq 100 index, comprising the 100 largest non-financial stocks listed on the Nasdaq exchange. It invests in Motilal Oswal Nasdaq 100 ETF. The fund will mostly capture the US technology and innovation narrative, gaining exposure to global leaders such as Apple, Microsoft, Amazon, Nvidia, and Tesla, the leaders in AI, cloud computing and digital transformation and clean energy. Since the last 5 years, the Nasdaq 100 has provided a rolling CAGR of 17.62%, way ahead of most emerging market indices. By performing better than this performance, the fund of fund allows to tap the US tech-led rally without having to use overseas trading accounts. As of August 2025, the fund has assets under management of Rs 56.32 billion, with almost complete exposure to Nasdaq 100 companies. Hence, it's a pure play on the growth of US tech firms. Its sectoral exposure is strongly biased towards technology, communication services and consumer discretionary sectors that are propelling the world digital economy. This fund has the potential to be a strong geographical diversifier, cutting over reliance on domestic market cycles and assessing global megatrends. Even though risk of currency volatility and volatility in the US market still exists, the exposure to innovation-led companies represents a high-quality long-term growth opportunity. Third is the Edelweiss US Technology Equity Fund of Fund. It gives access to the US technology sector by investing in the JP Morgan US Technology Fund. It provides exposure to some of the world's top tech innovators shaping digital transformation, cloud computing, semiconductor, artificial intelligence, and next generation software solutions. In the last 5 years, the US tech space has shown robust performance with industry leaders such as Apple, Microsoft, Nvidia, Alphabet, and Meta. By investing in this sector, the fund of fund has helped profit from the world's most cutting edge innovation hub without the necessity of investing directly overseas. As of August 2025, it has assets under management of 32.46 billion with strong concentration in technology, communication services and internet companies. The concentrated exposure renders it is a pure growth fund, albeit a volatile one relative to diversified international operations. It exposes to industry specific risk like regulatory shifts in the US technology industry and sensitivity to interest rate cycles globally. Returns could be further affected by movements in currencies that tend to boost returns when the rupee weakens. Now to conclude, when it comes to international investing, there is no single best option for everyone. Each fund presents a different window into global opportunities through multinational corporations, technology-led US indexes, or targeted exposure to the world's innovation leaders. Even though international funds provide diversification, they are not risk. The focus on specific sectors like US technology could accentuate volatility since it would enhance a portfolio's exposure to the sector during times of correction. A balanced allocation instead of overexposure ensures that international exposure plays a complementary role within a portfolio. The secret is to look at international mutual funds as a diversifying opportunity, not as a replacement for domestic equity. India remains an economy that is growing rapidly with good long-term prospects, but international exposure softens portfolios from local shocks while providing access to innovation and mega trends playing out overseas. So if you found this video helpful, don't forget to hit that like button and share it with your fellow investors. For more expert insights on mutual fund investments, be sure to check out our related videos and articles linked below. And if you're new to the channel, hit subscribe and tap the bell icon so you never miss an update on smart investing strategies. Signing off for now. Invest wisely, happy investing. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. Registration granted by SEBI, enlistment as IA with exchange and certification from NISM is no way guarantee performance of the intermediary or provide an assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.